Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday, December 13th, 2022, and I'm pre-recording this Trading Places Live for a little bit later this morning. Currently, futures are strong. We have a big CPI report coming out in less than an hour, so this could change dramatically. We've seen it recently where the CPIs come out and futures have really either exploded to the upside or been killed to the downside. I don't know which way it's going to go, but right now it looks like the market's in a pretty good mood, maybe hoping for a better than expected CPI report. Right now, Dow futures up nearly 200 points, S&P 500 futures up 23, NASDAQ futures up 78. Crude oil up 16 cents. We're just a little bit over $73 a barrel. And the 10-year Treasury yield down about 3 basis points to 3.58%. We're going to find out what happens here shortly. And, of course, we'll know by the market open. By the time you get this video and you're reviewing it, you will have had the information. I told our members yesterday, I'm not sure what happens here today. I mean, I want to be optimistic, hope the inflation report comes in weaker than expected. Hopefully the Fed meeting, which starts today and culminates tomorrow with the Fed policy statement at 2 p.m. Hopefully that goes well and the Fed acknowledges lower inflationary pressures and talks more about reducing the rate hikes, the percentage of the rate hikes and so forth, and eventually turns more dovish. That would be the Goldilocks scenario. I don't know if that's what we're going to see or not, but we'll find out in just a bit whether or not that's possible. Let's go ahead and run through today's agenda before we get started. I'm going to start off with the daily market recap, then talking technically, inflation, sector analysis, earnings spotlight, and we'll wrap up with the 3 you must see. First, before we get into any of that, I just want to take you over to earningsbeats.com. I do want to point out we have our free virtual event, Market Vision 2023, coming up on Saturday, January 7th. We're getting our speakers finalized. We're going to have a few of the folks from StockCharts joining me on Saturday, January 7th. Give you a little bit of a recap, what we've seen take place and what we see going into 2023. In particular, I'll be giving you my forecast for the entire year. I think my forecast has been pretty good the last few years. We'll see if I can make it 4 in a row, Saturday, January 7th. But again, it's free. No credit card required. All you need to do is register with your name and email address. So make sure you click here. This is a free event. It is going to be packed. We're going to reach capacity. So please make sure you register now. Save your seat. Moving on to the daily market recap. So on Monday, we saw the Dow Jones Industrial Average rally 529 points, back up above the 20-day moving average, which was great. S&P 500 did the same, rallying 56 points, up back near 4,000, now above the 20-day. The NASDAQ, which had been the weakest, also back above its 20-day yesterday. Excuse me, 11,144. That was a gain of 139 points. Mid caps up 25. That was a little over 1%. Small caps up 12. Also a little over 1%. Both of those, though, just beneath the 20-day, so they need a little bit more work there. As far as sectors go, energy led yesterday. Utilities also did well. Technology held up fairly well, as also all three of those gaining more than 2%. Industrials up 1.7%. Financials 1.33%. All 11 sectors were up. Unusual for a couple of reasons. Number one, it was a Monday. We don't normally see great market action on Monday. And number two, we have two of the biggest reasons why the market has been dropping in the second half of 2022 occurring here in the next 36 hours. We've got the CPI report for the month of November, which will be released here in about a half hour. Like I said, by the time you're listening to this recording, it'll be out. You'll have the benefit of hindsight to know what happened from that report. We've also got the start of the next federal meeting today. It just started. So tomorrow at 2 o'clock, Fed Chief Powell will let everyone know what they're doing with interest rates. Market expecting a 50 basis point rate hike. That's pretty much what the Fed's been telegraphing. But the Fed has been turning a little bit more dovish of late. Even Fed Chief Powell in his last speech, where the market soared, talked a little bit about how he sees the pace of these rate hikes decreasing. And that's the first step, is for the Fed to recognize. They've said they need to see a series, excuse me, a series of reports showing that inflation is under control. They're not going to let off the gas on these rate hikes until they see that. But they have been providing us some, at least a little bit more dovish speeches and so forth. So we'll see what happens here over the next 2 days. But these are two reasons why the stock market has been hit hard in the past few months. It's also the same reasons why we've seen liftoff in the market. So what are we going to see today and tomorrow? Hard to say. I wouldn't want to be out of the market, but I also wouldn't want to be leveraged in this kind of market. I mean, I believe the market goes higher. I wouldn't want to miss and be completely out of the market when we have these big up days, when the Fed does deliver good news, when we do see a reasonably decent inflation report. But in order to be on the long side, you have to be willing to take the risk of what happens if the alternative develops. And that's the hard part. So which way is it going to go? I don't know, but by the time you're listening to this, you will. Moving on, 10-year Treasury yield. So the only key economic report out today is the CPI. That's going to likely have a very significant impact on the 10-year Treasury yield. You can see when the October CPI report came out, see this big red candle right there? That was on November 10th. That was money that was pouring out of bonds, pouring into bonds. So Treasury prices were going up, but the yield was coming down. It was one of the biggest drops of 2022. We could see something similar today if that report is tame or tamer than expected or just not above. We could see a drop and maybe go back down, challenge the recent low, maybe break below it. And that could spur a major rally in stocks, especially in areas like technology, consumer discretionary, communication services, those areas where you see a lot of the high growth oriented stocks. Those are the ones that would benefit from lower interest rates down the road. They would benefit the most. All equities would benefit. But I think those would be the areas I would expect would lead if the inflationary data is less than expected today. But really, that's it. No other economic news out. So we'll see what happens, through the balance of the week. Obviously, again, we have the Fed announcement tomorrow, PMI later this week. There are going to be some reasons why the market moves up or down based on other economic reports. But for today, it's all about inflation. Talking technically, the S&P 500, there's that recovery. You can see right back up above that 20-day moving average. As I've been mentioning, this gap support is the one that I would be following the closest. I believe we remain in an uptrend as long as this level holds, 3860 on the S&P. You might say, well, wow, that's 130 points. We have no chance. Well, the last time we saw the CPI report come out, you can see the huge move to the upside in the S&P 500. So easily it could go down. When we had the September CPI report, look at the gap down here. It was probably down 2% at the open, maybe down 2.5% low of the day. And then we had this massive rally and recovered off of it. But we could see movement, big movement, either direction. Watch 3860 on the S&P 500. On the NASDAQ 100, the same level of support I would be watching, that's 11,350. Right now, we're at 11,706. So about 350 points lower, which would be a little more than 3%. But let's not forget, here on this CPI day a month ago, we gapped up 4%. The NASDAQ was up 7% that day. Who's to say if the inflation data is hot that we don't have something going in the other direction? It's possible. So watch that 11,350 level. See if we lose that. Okay, inflation. So this is a report that shows this is a pretty cool chart you can show over at StockCharts. The dollar CCPI gives you the consumer price index on the core basis, the core level. So this strips out food and energy. And what if you set the chart to monthly, because consumer price index only comes out once a month. So you don't need a daily chart. Otherwise, you'll just see lines that go straight across for an entire month before moving up. And then again, straight across for a month. If you pull up the monthly chart, all it does is just shows you the change each month. So you can kind of see what was going on here. Inflation was moving up, and then we went down. That was the pandemic, March through May. We had the huge spike in inflation March through May of the following year because we started to see the effects of the pandemic and the fact that prices were starting to rise pretty significantly a year later when everything opened back up again. And these readings, March to May of 2021, were replacing these readings from March to May of 2020, which had gone lower. So you had a doubling effect. You were getting rid of readings that were going down and replacing them with readings that were soaring. And that was what triggered the start of this inflation scare. And as we kept moving higher and higher, you can see inflation picking up. You were replacing these levels from 2020 that were relatively flat. They were going up, but they were going up very slowly. Here we were going up much more, on a much larger scale. And so as a result, that's what sent us up in March, right here to here. That's what got us our peak in the annual inflation rate. Now, what I had said then was over the summer, I could see us moving up one more time. And the reason was because over the summer of 2021, we had a few relatively flat readings. And if we kept going up at that pace in inflation, those higher numbers would replace these more flat numbers that ended in September. And guess what? September, we reached a peak. Okay. Now, September to October was a little lesser than expected. If we see another one in November, what we're doing is we're replacing these highly elevated readings with flat readings. And what I want you to look at down here on the bottom, this is a 12-month rate of change. Down here is a 1-month rate of change. And if you notice, the big 1-month rate of changes occurred back in early 2021. Last month, the rate of change was the lowest we had seen in over a year. So the 1-month rate of change is kind of giving us this rolling over effect here. And that's why I think today is really important when we get this inflation. I mean, are we going to see another big spike? Are we going to start opening this up again like we saw previously with these bigger month-over-month increases? Or was last month the start of a pattern? Trust me, this isn't just what I'm watching. This is what the Fed's watching. We get another low reading. Now, today, the expectation for November CPI is to rise 0.3%. October was 0.4%. Now, remember, that's headline. These are core readings. Last month, the core was 0.3%, and it gets rounded up. Here you can see I think it was 0.27 or 0.27 right there. So that was the actual reading. They rounded up to 0.3. For November, we're expecting core to be 0.4. So we're expecting it to rise back up here again. If this were to drop, say, to 0.2, it would really start to give this more of a look of a disinflationary environment as opposed to an inflationary. Inflationary is where we're going up. Disinflationary is where we're still above zero, but we're coming down. I mean, that for the bulls would be the best Goldilocks scenario. What we don't necessarily want to see is all of a sudden huge drops below zero, because that could be deflationary, not disinflationary, which is just small positive readings, but deflationary readings, which go into negative territory. deflation can spiral out of control to the downside and can be much worse than inflation. So the Fed's got this, they've got to be careful with raising rates. And I think that's why they've decided, hey, it's time to pause and start to slow down, because we are seeing some better signs in the inflationary world, and we don't want to overdo it with the rate hikes. And once the stock market gets that sense that these rate hikes are over or coming to an end, I would not bet against equities. If this annual rate rolls over and goes back down below the lows we saw in June, and I don't think that's going to happen this month, but I think it could happen in a few months. Once that happens, I think we trigger a tsunami of buying, if it hasn't already triggered, because a lot of times the market will look ahead. We'll see. We are going to find out. All right, let's move on to sector analysis. And what I wanted to show you here was the individual groups. This is a 2-year chart of the S&P 500. Actually, it's a 3-year chart of the, excuse me, not the S. This is the XLK. And down here is the XLK relative to the S&P 500. So you can see in 2020 and 2021, as the market was going up, technology led. When the market comes down, technology tends to go down and it tends to underperform. When the market starts to become strong again, we tend to see leadership in technology. When the market's weak, we tend to see underperformance. Well, we've been rising again. It took technology a little bit longer to get started. You can see the low on the XLK was back in October, but its relative strength didn't bottom until the beginning of November. But it is starting to move up. Recently, the XLK is a little bit off of its recent highs, but look at the relative strength breaking out. I find that to be a positive. And this is, in my opinion, the most important sector to watch. If you believe a secular bull market is beginning again or resuming, I mean, it's been underway. In my opinion, the market has been in a cyclical bear market. We've remained in a secular bull market. You can have cyclical or short-term bear markets within a long-term or secular bull market. And I believe that this drop that we've seen in the S&P 500 right here throughout 2022 is all part of a cyclical bear market. That's my belief. You can believe what you believe. And so as we resume a move to the upside, if in fact we do, XLK will be the sector to watch, because I do expect to see leadership here. So if the report today is good and the market has a big day to the upside, watch technology. If we get that breakout here, that would be a very bullish development. And I say get the breakout here, I mean on an absolute basis. We're already there on a relative basis. Next up, let's take a look at the discretionary group. This is, I would say, the second most important group as far as I'm concerned. It's been moving down. It's really struggled. Look at the relative strength of the XLY. It's down back close to the May low. So while technology is showing some pretty good signs, discretionary is not. And there are two primary culprits. The good news is when Tesla and Amazon are doing well, they tend to carry the XLY because they're 45% of the ETF. When Tesla and Amazon are not doing well, you're going to see underperformance by the XLY. And that has been the case over the past few months. Tesla has been weak. Amazon has been weak, and much weaker than the S&P 500. And as a result, the XLY is struggling. So if you want some strength coming out of the XLY, you've got to see it in Amazon and Tesla first. You can't have almost 50% of the ETF underperforming and expect the ETF to outperform. It's just not going to happen. So a lot of work to do. Got to get through 150 here on the absolute chart on the XLY and need to hold that May relative low. That's from a bullish perspective. That's what I'd be looking for. The XLC, the big reason I like the XLC and I find it to be very important is because it houses the internet stocks. This is a pretty important group that can grow their earnings very rapidly. And so as somebody who believes in the secular bull market theory, you want these high growth areas to really start to move higher. The good news is We have seen the XLC bounce at the beginning of November, just like technology. And we've seen relative strength come in, but not to the, to the level that I certainly would be expecting. I mean, we need to get back up probably above 0.136 or 137. Take out that October high. We still got a long way to go there. The XLC has a little bit of a sloppy head and shoulder bottom. There's a left shoulder, neckline, head, neckline, right shoulder. So the right shoulder is upsloping, which I like. I'd like to see this break out with some gusto above 53. That would be at least a short-term positive for communication services. The XLF, starting to see some nice strength here. This is the time of the year when the financials tend to outperform. October and November were very strong months. So far in December going down. I wouldn't be surprised, though, to see this start to turn back up again on a relative basis. I think once we move into the new year, if the market does remain healthy or healthier than it was earlier this summer and can continue to trend above its moving averages, I think we're going to see money begin to rotate into the XLK and the XLY, and not so much the XLF. But through year end, the fourth quarter is where financials tend to outperform, when they tend to do very, very well. And we've seen that in this fourth quarter so far. XLI, industrials, also love the fourth quarter. Look at what's been going on here in the fourth quarter. Look at the relative strength. I think this comes to an end. I would be rotating out of industrials, because what they are doing right now is typically what they do just about every year. They significantly outperform in the fourth quarter, and then on a relative basis, they tend to struggle throughout the balance of the year. This is when, if you're going to more heavily concentrate in industrials, this is the time to do it. Now let's talk about some of the defensive groups. First of all, healthcare. Healthcare has been very strong. Beautiful move up fourth quarter. Biotechs have been doing very well, which is the aggressive part of the healthcare area. And that's been helping to lead healthcare higher, but you can see a breakout to a new high. Healthcare has been one of the best groups over the course of the last year, consistently outperforming the S&P 500. How about XLP, consumer staples? That's the counter of consumer discretionary. Staples been rising in the fourth quarter. We've been moving up most of this year. Staples have been leading. But most of this year, we've been in a downtrend, in a cyclical bear market. Defensive groups tend to lead. They don't tend to lead, they lead in bear markets. They will outperform the aggressive groups and therefore outperform the S&P 500 in bear markets. Now, some of them, especially healthcare and staples, have been moving up while the market's been moving up. I talked about that with members yesterday in my daily market report. I'm not overly concerned about it, because this is one secondary indicator, and it's mixed. And I'll show you what I'm talking about with mixed in just a second. Let's look at the XLU. XLU moving up. We've been moving up a little bit here, breaking out to about a 3-month relative high, but we're still way below where we were in September. So we're not moving up to any new highs here. And that's why I think the defensive groups are a bit mixed. We're not breaking out to a new high here. Took a pretty big relative tumble earlier, and now we're starting to make up for it a little bit, but we still have a long way to go. And now check out real estate. Real estate, yeah, it strengthened a little bit, but look at where the high was all the way back in April. This is a defensive group that has been doing very poorly on a relative basis since April. So it's not like they're all going in that same direction. Maybe over the last 30 days they are. Real estate a little bit. Utilities maybe a bit more. It's mostly in the staples area. And a lot of that money coming out of discretionary is finding its way into staples. So that ratio has not been performing very well. But anyway, that's basically what I wanted to show you as far as the sectors go. Energy and materials kind of can go up or down in any market. I really wanted to show you what was going on in the aggressive versus defensive areas. All right, let's move on to the earnings spotlight. yesterday after the bell. Oracle reported. Oracle was doing pretty well, was not in breakout mode yesterday, I don't think, but we will take a look at the pre-market action here in just a second. But it is in a nice uptrend. It did break out and reach levels that it had not seen since all the way back in the middle of January. So, excuse me, Oracle doing very well. Relative to software, Oracle has been a very strong performer relative to the S&P. I would have gone into this report expecting a decent report. They beat on their top line. They beat on their bottom line. And this morning, they are up 83.64. So they're pretty close to that recent high, up almost 3% with a nice positive reaction. We'll see if we can get that breakout above 84. That's going to depend a lot on that CPI report, and that comes out in just about 9 or 10 minutes. All right. Let's go back and just take a look, because there are a couple of other stocks that will be reporting later today. They're much smaller companies than Oracle. These companies are in the $1, $2, $3 billion range in terms of market cap. But they'll report, I think, after the bell today. One is ABM Industries. You can see the stock's been rallying pretty nicely here over the last 3 months. We'll see if it can hold the 50-day moving average. It would be bullish to see the stock break out above 47.5 to 48. BRZE, this is Braze, currently up 1% in pre-market, but they will be reporting. This is a stock that's been downtrending, and it's now testing its 50-day. We've seen some of these stocks do pretty well. Let me pull this up here. We'll look at it on a relative basis. But we've seen some of the software stocks begin to do better. You can see software bottomed at the beginning of November, starting to, trying to move to about a 3-month relative or 3-month absolute high. And on a relative basis, we can see the software here has moved off the bottom from back to the beginning of November. Braze, however, has been one of the worst performers. It's seen a little bit of a pop here recently on light volume as it gets ready to report. I think the report is not going to be great, so I think you better be careful with Braze. If the CPI report's not great and Braze reports later today results that are underwhelming, we could see a big drop here. This is one I'd be careful with going into earnings. All right, let's move on. 3 you must see. Let's wrap up with 3 stocks that have been struggling. One, Moderna. Moderna was moving up in a nice little cup, and then all of a sudden broke down the last couple of days. Volume picked up yesterday. I would be maybe looking for a move back down to the 50-day. This is a volatile stock. News comes out all the time. It's hard to tell. It can move whichever way, but I wouldn't be comfortable unless I was seeing at least a 50-day test there or waiting for a breakout. Tesla, mentioned it earlier. It's been really struggling the last few months, and there you go. You can see it. It was $310 3 months ago. Now it's $167. It's almost been cut in half in the last 3 months. So if you're wondering what's going on with the XLY, here you go. It's Tesla. Tesla's been struggling. And then finally, and we're right down near, we're either putting in a double bottom or on the verge of breaking down again. So keep an eye there. Target, remember they came out with their earnings so weak and they had this huge gap down. Well, they went through about a 1.5 week, 2-week period where they bounced. Now they're right back down to that area where they gapped. This is not a very good looking chart. I think 138 to 140 could come in play if they lose 150. All right, that's it for me. I appreciate everybody tuning in. One last thing I want to mention again, we have our free virtual event, our Market Vision 2023 event coming up on Saturday, January 7th. It is a completely free event, no credit card required. We want to provide you with some of the best technical, historical, sentiment information, fundamental information that we can. I think you're going to find it right here at this event. Mark your calendars, and better yet, click on this register now button and register. Have a great day, everybody. Let's see what happens with the CPI. We'll go from there. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.